If you own multiple franchise locations and are turning a healthy profit, 3 new tax changes just came out of the president's new bill that could save you tens or even hundreds of thousands of dollars in tax. Today, I'm going to walk you through 3 of the biggest advantages that came out of Trump's new bill, the big, beautiful bill that can seriously save you big time on your next tax bill. These changes are tailor-made for franchise owners that are already growing, reinvesting, and successful, especially if you're planning on additional expansion. The first big change is bonus depreciation at 100% is back. Bonus depreciation did exist in the past, and it was at 100% before, but from the last Trump bill in 2017, that strategy was set to disappear essentially. With the big, beautiful bill, that was brought up back to 100% and indefinitely. And it even expanded what you can expense. So if you're planning on buying equipment, doing a remodel or a build out, or even upgrading your software system, or even buying new vehicles, you can now expense 100% of the cost of those purchases. And here's the kicker. Even if you don't pay for those things in cash, if you finance those, you still get to take the whole cost of the asset the year that you buy it and place it in service. Depending on your effective tax rate, as an example, let's say you put $500,000 in reinvestment into your business, that could spell around 175 grand that you would save off of your tax bill. Big change number 2, QBI. QBI stands for Qualified Business Income. This is a change that came out of the 2017 bill as well. And essentially what QBI did is said, hey, what is your taxable net income at the end of the year after all expenses? You get a 20% deduction from that. Very simple example. If you were going to show a net income of $300K, you're able to now take a $60K deduction off of that. But QBI changed with the big, beautiful bill in a big way. Now, instead of QBI being based off of net income, it's based off of EBITDA, which is typically going to be a much bigger number. For the most part, to get from net income to EBITDA, we're adding back depreciation, amortization, and your interest expense. Taxes will apply as well if applicable. Let's walk through an example. Let's say your business is showing $250K in net income and bottom line for 2025. But when we add back depreciation, amortization, taxes, and interest, we actually show an EBITDA of $450K. So the way that the bill worked before, or the way that the previous bill worked, you would, in this example, get a $50K deduction or 20% off of the $250. Now you're going to get 20% of EBITDA, so that'd be a $90K deduction, and that's going to come off of the $250. So as a percentage, you're getting significantly more than 20%. In this case, closer to 40% off your net income. Now there is an income threshold. So if you're a married couple, for example, if your income exceeds just over or just under 500K in taxable income, QBI would not apply to you. Does this mean if you make more, you should just ignore this as a strategy? No, you should consider that you can combine these different strategies to bring your income down to a level where you could still use QBI. So tax planning is not just about what is the strategy and how does it work, but how do certain strategies change my income level that unlock other things that I couldn't otherwise use. That is really, really good tax planning. Big change I want to bring up here at number 3, the SALT cap. And this kind of ties into what I just said about taking advantage of, as much as you can and using one strategy to unlock others. So what is the SALT cap? Before, and again, this came out of the last bill that Trump put out in 2017, the Tax Cuts and Jobs Act. He reduced state and local tax deductions to $10K. So if you have income tax, sales tax, property tax, any tax that you're paying within your state. Before you could deduct, there wasn't a cap on it, and then he put a 10K cap. The new bill, the big beautiful bill, just increased that cap to 40K. So 4x what you could deduct before. So the same catch almost that applies to QBI and its cap applies to SALT. So again, you have to stay at around under 500K in income to be able to take advantage of this. If you exceed that 500K for SALT cap, it reverts back down to the 10K. So this is another example where combining a few different strategies like the ones we're talking about here and the many, many more that are out there, you'd reduce your overall income and unlock your ability to take the 40K deduction if your state and local taxes are that high. Now you might be wondering, isn't this something that all franchise owners are aware of? Surprisingly, no. We talk to dozens of franchise owners every week, and it's absolutely shocking the percentage of them that just are not aware of any of this. They don't know what they're allowed to do. They don't know when new opportunities come out. And we find that a big part of the problem is the type of relationship that they have with their CPA. Not necessarily saying anything bad about their accountant or CPA. They could be great people, but a lot of these relationships are set up where once a year, if that, and it typically happens after the year is already over. That's a problem. The majority of tax strategies that you can use to greatly reduce what you pay in taxes have to happen inside the year that you want them to take effect. So the bonus depreciation strategy, if there's 100K in assets that you could acquire that would help you grow, and you decide to get those in January instead of December, that could spell a 30, 40, 50K swing in what you pay in taxes. So again, not to knock the CPA, but the relationship might just not be set up right. You really need to work with somebody that you're strategically planning with month after month and quarter after quarter, so that you're in the absolute best spot that you can possibly be in specific to your situation. We've seen franchisees leave 50K, 100K, even 250K in taxes on the table that they didn't have to pay, but they did not strategically plan, and they were not really working with an advisor in that way. So what's the opportunity for you here if you're a growing and profitable franchise owner? If you're a multi-unit owner, that absolutely helps. You can reinvest and grow your franchise in an accelerated way, where you're going to get these big tax deductions up front. The big beautiful bill is absolutely a win for profitable franchise and business owners. Our firm works with profitable and multi-unit franchise owners. We help you guys turn the tax code and rules into real money and growth. We work exclusively with profitable and growing franchise owners, and we help you use the tax code and these rules to translate them into real cash flow and business growth. So if you're a multi-unit or a profitable franchise owner and you want help in turning these changes and everything else that's out there into just paying the least amount you can in taxes, check out the description below. There's a scheduling link. It's absolutely free. We'll talk to you and walk through your situation and see what you might be missing. Again, no charge for that. These tax changes are active right now and they're powerful, but they really only mean something to you if you act. So if these things again sound like they could be helpful, go ahead and schedule your free consult in the description below, and don't forget to subscribe for more videos like this on how franchise owners can succeed in business and again save as much in taxes as possible. See you next time.